Good morning, all. A very warm welcome to all participants. Myself, Anupam Petkar, welcomes you all to this webinar knowledge series for finance, corporate affairs, industry, capital market for professionals in industry and financial sector. This study group has been formed with the objective of having knowledge interactions, especially amongst professionals from industry. We have members who are finance leaders working in reputed companies since many years and have deep domain knowledge. Before COVID, we used to have these regular meetings, which were very temporarily stopped due to lockdown restrictions. We are we are now moved to a digital medium by launching through the webinars. As participants are aware, today we will be covering topics on NBFC sector, latest developments, performances, for analysis, trends, and compliances. Our first speaker, CA Ramesh, is a senior industry member. He was associated with CRISIL since last 15 years in the areas of financial sector ratings. He has been a panel speaker in various forums since many years. Our next speaker, our next speakers are CA Sandeep Maheshwari and CA Kavita Maheshwari. Kavita ji have been handling compliances of capital markets and NBFCs. Sandeep has a rich experience in professional firms like NM Raji. We'll be covering various topics like industry performances and financial statement analysis, wealth management, charts, market trends, and various topics suggested by members. I encourage members to join any of our WhatsApp groups to get more updates. We also have a YouTube channel uh, where members, which can be, well, the links to both of these will be shared through our chat section. So I once again welcome our speaker, CA Ramesh, and request him to start the session.
Thanks, Anupam. Hi, this is Ramesh here. Uh, a very good morning to all of you. Hope you're able to see the screen now with the first slide of Think Tank Webinars Knowledge Series.
Yes, Ramesh, we can.
Yeah, sure. Can we start?
Yeah, we should start. Yeah, thanks.
Okay. So, NBFCs have always been a very, at least for me, they've been really fascinating business. Um, I always used to kind of feel that, and also I used to comment at various fora that NBFCs are like cavaliers. They go and develop new markets, and in that process, they perish. Some of them perish, and they develop the markets for a few years, and then finally, banks hijack their business, and they're kicked out of the market. So that's the way they have been, say, since their inception, and it still continues. You take the case of any product. Um, there was a time in early 90s when NBFCs are kind of synonymous, were kind of synonymous with commercial vehicle finance. That's where they started. And after a decade or so, banks entered this business. Though still NBFCs have a very strong presence in the commercial vehicle finance business, banks have almost captured 50% of the market. So take the case of housing finance. It all started with HDFC way back in 1980, early 1980s. And probably post 2000, banks entered the business and have captured more than 60% market. So you take any product, NBFCs develop the product in India, and then some of them perish, as I said, in the process, not knowing how to do, what to do, and others learn from the experiences and progress. So very fascinating business model. They have to keep on reinventing themselves. They have to keep on finding newer and newer areas. But at the same time, it's not going to be a permanent business for them, as better players with better cost structure come and occupy them, kind of drive them away. So having said all this, let's come to the present situation. NBFCs have been they have been the bad boys for almost 2 years now. Partly for right reasons and partly for wrong reasons. I would say right reasons because a part of the problem that they are facing now is their own making, or at least some of them have contributed the misery to themselves. while some of them have done very prudent business. So, I mean, unfortunately, fortunately or unfortunately, it started with the collapse of ILNFS, which to me is not a pure play NBFC. It had a financial arm, but it was not doing um, um, a very arm's length type of lending to external world. But however, there have been some issues with that NBFCs have been kind of issues in the sense NBFCs had been trying some business models probably since the easy money policy with benign interest rates, which we had been seeing since 2013-14 or somewhere around that, or even prior to that. Certain business models had been developed um, because funds were available at a cheap price, uh, particularly very volatile funds, short-term funds. And those funds became a business model for certain NBFCs. Very, very short-term funds became a business model or kind of part of one segment of a larger NBFC. One vertical of that larger NBFCs started using these funds and was developing a model. And that, I think, is the crux of the issue, the ALM issue, because of which I believe ILNFS was the last straw, which it kind of uh, which set the scene for explosion or probably implosion, we should say, because not many collapsed. A few large NBFCs collapsed. Um, so ILNFS, as I said, this is strictly not an NBFC. The second case comes to DHFL, which still I believe is definitely not because of the collapse was certainly not triggered by um, uh, the business issues alone. There were very clear corporate governance issues, as we now see it has come out. Though, of course, there were business issues in terms of the wholesale lending, but certainly it would not have led to a collapse, is my belief. So that is another second event. Third, of course, we know about other companies in the Reliance Group and then Altico, which defaulted. There were big names which still are able to kind of uh, keep the danger or keep the issue at bay, but still are fighting a battle for their survival. So we'll look at some of it um, in this presentation. Um, so as I said, just to get back to the background, as I said, NBFCs have been pioneers in most of the developing new products. Um, as they keep doing it, they kind of enter some territory which is, I wouldn't say prohibitive, but which is very difficult or which is very challenging to tread upon, and because of it, they get into problems. And ILNFS was the last straw, and therefore the ALM issues, because of the short-term funding, came out very strongly after the September 18 ILNFS collapse. And NBFCs which had these businesses built around short-term funds were in deep trouble. Short-term funds, I mean funds which are less than 1 year tenure, mostly largely say borrowed through CPs, issuance of CPs, and mostly invested by mutual funds. I'm stressing the word mutual funds here. I'm stressing the word CPs, commercial papers here, as we will see subsequently what are the issues with these. So for almost 6 months, there was a big lull in the market. Most of the NBFCs were just managing to stay afloat during the first 6 months after the ILNFS collapse. But after that, I think very strongly market started distinguishing between NBFCs which are having prudent business model and uh, and or strong parentage. So NBFCs with a prudent business model in the sense that there is no ALM issue, or the ALM issue is well managed. There is no major risks being undertaken. Primarily retail NBFCs, say vehicle financiers, auto financiers, um, gold loan companies, MFIs, to a large extent even MSME financiers, lab financiers. Lab financiers, not entirely, but to some extent we can add lab financiers as safe. So people or the market, the investors, the lenders to the market, and banks as well started distinguishing between NBFCs which are doing prudent business, which are prudent ALM management, and those which are not. Who are these companies which market believe that they are not managing their ALM prudently? Most of them are in the wholesale financing business. NBFC means it was just retail all the way since it started. Only in the last few years, the wholesale finance started gathering momentum. When I say wholesale finance, there are two major portions. One is the corporate finance, lending to a corporate for working capital purposes or even term loan purposes, which is a decent portion, must be around 30-40% of this wholesale finance. The next 60% is the developer finance, which is really the crux of the entire issue. The NBFCs raised funds on a short-term basis, 6 months, 1 year, or maximum 2 years, and lent on a very long-term basis. Of course, developer finance need long-term funds, but the question was, would the NBFCs be able to extend that long-term credit? As I said, that's what I said in the beginning, NBFCs are pioneers. They try and develop a product. That's how they've tried this also. But some of them have really been, the result has been disastrous for some of them, or many of them. So long-term funds means it is not just the construction period. They have given very long-term funds, say 4 years, 5 years, 6 years. And also the repayment is back-ended. So for the entire construction period, the construction period itself is not something which is definite. I mean, it can get extended, and typically it gets extended. So the NBFCs have given them cushion and back-ended repayment. And repayment anyway is dependent upon the sales velocity in the real estate sector. So first issue with this wholesale finance, of course, the corporate finance is not a major, did not have a major issue, and the size also was not bigger. The wholesale finance with developer finance, the developer portion of the wholesale finance, had this issue of funding misaligned. And second was this real estate market, particularly the residential real estate, which had been performing badly even today for the past few years. And therefore, the ability of the developers to repay the loan was also highly suspect. Therefore, all these problems compounded and kind of dawned upon these wholesale financing NBFCs. So a problem which started with kind of liquidity has turned out to be a real asset quality issue. If you ask me, for an NBFC to collapse, yes, liquidity is very important. I mean, you don't that.
You have to figure out now.
You need to have strong capitalization. But the crux of the issue, if an NBFC has to collapse, it is the asset quality. If the asset quality is worsens, it is sure to bring the NBFC down rather than say profitability or capitalization. So what was early in the early part of this downwards spiral, what looked like an asset ALM issue has really turned out to be a asset quality issue. I'll tell you why it is still not visible, even with those NBFCs which are neck deep in trouble. Yes, it is now 2 years even then asset quality is not showing up. Yes, if you look at the wholesale NBFCs, I don't want to name them, but you know very clearly developer finance NBFCs, large ones who are there in the business, we all of us know. So certainly if you look at the asset quality numbers, it has moved up from 1 or 2% gross NPA in March 19 to 5-6% in March 20. I mean, that is not the stress we are talking about. You look at any other NBFC segment, say vehicle finance is still at 5-6% NBFC. Lab finance is also 5-6% gross NPA. So that's not the stress we are talking about. It's going to be much worse than this 5-6%, which is visible now. That is because of the moratorium which most of the borrowers still enjoy. Even a year back, today we are in November 2020, even a year back, about half or at least 40% of the loans taken by these borrowers were under moratorium. I'm talking about NBFC exposure, right? The entire, this thing is on NBFC exposure. So it was supposed to come out of moratorium by March 21, but we have this COVID problem because of which moratorium was extended, and now restructuring also provision, restructuring provision has been created, and therefore most of the developers would go for restructuring. So the problem is not likely to come out for at least one more year. There is very incipient stress in this segment, but is unlikely to come out at least till March 22, where some of, if the real estate market, particularly the residential real estate, doesn't come out, we will see huge stress coming out of this market. So just to give you some in terms of numbers, the wholesale piece of this NBFC, okay, the entire NBFC segment, if you ask me, it's about 29 trillion, 29 lakh crore. Okay, that's the entire NBFC segment, including government NBFCs all put together. 29 trillion, 29 crore. You know, versus the banking, if you look at the banking exposure, it's about 102 trillion, 102 lakh crore. And NBFC is about 29 trillion. Out of this 29 trillion, the wholesale piece is about 3.3 trillion. Okay. Out of this 3.2 trillion, roughly about 60%, which works out to close to 2 trillion, is the real estate exposure. And this is where the stress is. And as I said, it's about 5% or so. Gross NPA is visible, but it's difficult to put a number to it as to what will be the stress. As of today, if you are going to look at the real stress, probably it will be in the mid-teens to high level of teens. It's a anybody's guess, but if you put some logic to it, then probably it will be somewhere close to mid-teens to high teens, and still evolving. This is not what we have seen. So we have not reached the bottom of the pit. So that's the key issue with this sector now. Yes, COVID-related stress, we will look at it in the subsequent slides in asset quality and how the sector looks like. But if you ask me the story that the whole segment is going through, the issue the whole segment is going through is this. So I'll just pause here to take any, to hear any comments or take any questions that you may have.
So Ramesh, Viral over here, I don't know, am I audible?
Yeah, you are. You are Viral.
Hey, Ramesh, trying to understand that why do you say that this stress will not come out till March 2022? If you can elaborate that a little bit, I'm trying to understand. And what do you think at all is being done or can be done to sort of clean this? Because we keep on hearing the same thing over and over again about the developer finance and so on and so forth. So what can be done to sort of make this right?
Right. So on the first part of the question, see, as I said, Well, as on say September 2019, okay, last year September, the broad estimate was that 40% of the loans were still under moratorium. Okay, and about half of it would come out of moratorium by March 21. That was the estimate as on September 30 last year. Had COVID related moratorium and COVID related restructuring not been there, so a major portion of the exposure which was under moratorium would have come out of moratorium, and the loans would have become due, and we will know, and we would know whether they have repaid or not. So probably a lot of it stress would have come out had this COVID related moratorium and COVID related restructuring not been there. Since this moratorium is there for COVID from March 1st this year, and now restructuring provision is also there. So all those which were under moratorium would continue to be under moratorium and would further be restructured. So that's why I'm saying, and the COVID restructuring is for 2 years. I mean, you can give for 2 years restructuring, and that's why I'm saying at least till March 22, the present situation would continue, because no further loans will fall due, and therefore there would be no repayment happening. And that's why I'm saying at least till March 22, the stress is not likely to be visible. And I'm being a little conservative there, because if you take if most of them get the 2-year window, then it will go even up to December 2022. So probably after March 22 and certainly after December 22, the stress will come out unless the real estate sector revives. So that is one first part of the question. Second part, I think.
Yeah, that clarifies. Yeah, that clarifies the first part.
Great, great. So the second part of this question, see, this business, developer business, we have understood now. I mean, I'm not blaming anybody here, because as I said right in the beginning, NBFC is a fascinating business. You kind of develop new products.
Ramesh,
Yeah.
on your slide, just the cover slide is there, I think. Can you turn the slides?
No, we are ready to get into the slides. We are just in the background.
Okay, okay,
So
okay.
we will get into the slides.
I think
I thought this is a crux of the issue where I did not have specific slides. We'll discuss that. We'll get into the slides and talk about the sector. Probably it will take half an hour. Should be sufficient for that. Sorry. So as I said, NBFC is a fascinating business as they go and develop new products, and that is how people were trying to develop this developer finance in the NBFC model. So the business model or the balance sheet doesn't support the long-term financing. You have an asset which needs to be financed for at least 3 or 4 years, whereas your liabilities or maximum could be for 3 years. Even if you raise, say, NCDs, non-convertible debentures, very prudently, it will just be for 3 years, but that would have been manageable. But probably the economics did not work out, and therefore NBFCs took recourse to short-term funds and used this model for lending long-term with a strong confidence that they'll be able to roll over the short-term funds. If the liquidity in the market tightens, the first thing to collapse is the CP market, right? And that's what happened.
Yeah.
So the reliance on the short-term funds was a bigger flaw in this model.
was wondering, he forgot.
And the second flaw is the suitability of this product for this NBFC structure. There is a regulatory angle to this as well, because you need to have a strong capital, right? Because regulation says NBFCs can't lend more than 15% of their capital to single party. But you need to have a strong capital to do this, because developers need small developers barring, but mid to large size developers need a good amount of funds running into, say, 50 crores, 100 crores, 200 crores. they can't be hunting around with various NBFCs. So they would want to get from one or two NBFCs. So you need to have strong capital also. So there is a regulatory angle to that. So the suitability of this lending to the NBFC structure is a big question now. Now, how is it getting cleaned up? So people have tried selling the assets, and to some extent they have been successful. Who is buying? Of course, the AIF kind of structures are buying, where there is no regulatory angle. The AIF need not maintain, need not conform with the RBI guidelines, particularly the one which requires single party exposure, which is 10-15%, group exposure to 20-20% and all that. So that regulatory angle is taken care of in AIF structure, and the ALM issue is not there. AIF PE fund can be there. So probably some of them are moving. I mean, recently we saw Edelweiss doing some about 3,000 crore or odd amount selling to a AIF kind of structure. We have seen this Indiabulls doing it. We saw even DHFL during in the early period after the crisis started. So probably some of it, I wouldn't say all this 2 lakh crore which I spoke about earlier, or even a big portion of it is unlikely to go to AIF structure, but that is one possible option where some of it would go there, and therefore good projects which are really viable would go there. But the rest of this 1.5 lakh crore, whatever, I mean, it's an estimate. So estimate can vary between 1.5 lakh crore to 2 lakh crore. So I think the only way here is the NBFCs, if the market doesn't revive, if the real estate market doesn't revive in the next 1 or 2 years, those NBFCs will have to kind of bear the brunt. That's what the situation looks like now. Let's see how it evolves. Viral, does that answer your question?
Yeah, Ramesh, thank you so much. It does answer the question.
Sure. Okay, let us get into the slides. So I'll cover a little bit of basics as well, just to set the tone for the rest of the presentation. So there is this classification given by RBI. This is mostly for regulatory convenience. You can't have one set of rules applicable to all these type of NBFCs because all of them are doing different types of business, different borrowers, different geographies. There is so, for example, as I said, you can't have a rule which is applicable to an infrastructure NBFC, infrastructure finance company, which also applies to a company which is into retail financing, right? For example, infrastructure funds, they would require capital in a very large extent. So the minimum required capital for an infrastructure finance company is, I think, about 300 odd crores. But whereas for any other NBFC, it's just about 2 crores. And similarly, for a wholesale finance company, you need to have a specific amount of the capital requirement, 15% for single party exposure. So and for say MFIs, there are specific guidelines because it's a completely different ball game. So all these various classifications which have evolved over a period of time, this is regulatory classifications, and they are kind of made to support better regulation. There are other types of classification as well regarding, say, the way in which the business of the company. For example, peer-to-peer lending. That's another classification. There is account aggregators. NBFCs, certain NBFCs are termed as account aggregators, which is something which is evolving now. So such classifications are there. Regulatory classifications are more to do with better regulation. This is another classification, mostly from the liability side, deposit taking and non-deposit taking. And non-deposit taking further broken down into systemically important and non-systemically important. Again, regulation has a major role to play to classify these NBFCs here, because deposit taking NBFCs, there are only a few, as you can see, 69 as on February 2020. Probably it would have come down further by now if I look at the latest number, because these NBFCs need a stronger regulation because they deal with public funds. It's almost akin to a bank, right? Accepting public deposits. So they are subjected to very stringent regulations as compared to non-deposit taking NBFCs. Again, within non-deposit taking NBFCs, the focus of regulation is more on systemically important. So bigger NBFCs which have 500 crore and above of asset size, where public funds are involved indirectly, either through bank borrowing or through, say, public debentures, or through any other mode, even the CPs. So if where there is no direct borrowing, like in the case of deposits, but where there is indirect borrowing through banks, and if the size exceeds 500 crore, the regulations are stringent, both in terms of the regulation as well as in terms of the regulatory supervision. More stringent, say, inspections, more stringent norms to be followed. So that's how the classification. So this was the history I was kind of talking about at the beginning. I have put the history for the last 10, 12 years. I mean, we can stretch it back to even 90s, but I think this is more relevant. So if you start looking at from, say, 2005, 2006, 2007, it was a great period for the NBFCs. They were doing very good business, and it was a good period for any lender. And then came the global financial crisis, where there was certainly a big dip. And then it was followed by a kind of a moderate period, somewhere around 20%, 25% growth, till about 2013-14. And then we have not had a great period for NBFCs since, say, 2013-14, for one reason or the other. The first one being the taper tantrum with the quantitative easing, which was followed by US was getting withdrawn. And then a number of issues like the demonetization came in end of 2016. And of course, the liquidity crisis, the bigger liquidity ALM crisis, which struck in 2018. So this has been a, last 10, 12 years have been a clearly bumpy cycle for NBFCs. It has always been like that. As I said, if you go back 2007 also, it will, the graph, the growth graph will look more or less similar to what we are seeing now. But clearly, NBFCs are performing better than, much better than the nominal growth that we see in GDP. They are definitely outperforming. See, nowhere here they are underperforming the economy. They are performing better than the economy. I think that is what is the key. That is the reason why they survive. That is the reason why they thrive in this very competitive lending sphere. So with this, if you go to the next slide, here I've given a comparison of growth between banks. Though I will never say that they compete with banks. I think banks, even public sector banks, can beat them hands down because of the very low cost of funds. But NBFCs will definitely beat at least the public sector banks hands down in terms of service, in terms of ability to reach the remote part of the geography, ability to understand the customers better, ability to serve the customers better, ability to customize the product. So all these things they are far ahead, whereas in terms of cost, they are nowhere near either the private sector banks or public sector banks. But having said that, you look at the orange line. Orange line has been, which is the growth line, has been even above the private sector banks in most of the years in the last, say, 5-6 years. It's only after this liquidity crisis, which came in September 2018, the growth has actually come down sharply, even below the public sector banks. So clearly, in terms of business, NBFCs are very strong, have very strong business proposition. Their ability, as I said, to develop new products primarily, expand new frontiers, new geographies, new customers, new type of customers, new type of borrowers. For example, a bank would never touch a chaiwala, right? It's quite probably today a small finance bank could lend, but if you look at the normal universal bank, they would never lend to a chaiwala. They would never lend to a artisan who's having a very small business, who want to just about 50,000 loan or 1 lakh loan or maybe even 3 lakh loan. They would not touch a roadside garage owner or a small tailoring shop with a few tailors. You give any example, bank would never touch them because they do not have proper documents to prove their income. And here is where the NBFCs have come in, and they have developed products for these sort of customers. They have developed products for these sort of these kinds of, say, borrowers. So such innovation has helped NBFCs to be ahead of both private sector banks and public sector banks. So if you look at this slide, it's again giving a brief background about what are the various products that NBFCs operate on. So the key products are only, say, 2 or 3. I mean, which actually make up to the majority of that 29 trillion that I was talking about. So the key products would be first auto finance. This would include commercial vehicle. This would include passenger cars, everything. And this would also include even two-wheelers. I think two-wheelers are not mentioned separately. So auto finance brings everything together. So this is a major portion of 9 trillion. Second, a home finance or housing finance. In fact, housing finance is bigger than auto finance. If I have to put some number, housing finance be close to 10 trillion. So those who are not speaking, if you can please be on mute. Yeah, thank you. So housing finance actually is the biggest portion. Then comes the auto finance. Then comes this infrastructure finance. So infrastructure finance is again a big portion, about 8-9 trillion or 8 trillion, 8.5 trillion. But this is dominated by just 2 entities, and that 2 are government entities. So PFC, Power Finance Corporation, and Rural Electrification Corporation. They will form about 85 to 90% of the infrastructure finance book. The rest of them are, say, L&T Finance, L&T Infrastructure Finance, or Shrey Group, or to some extent Tata's. All those things, I mean, there are other smaller players, but they form about under 10-12% of the entire infrastructure finance. The rest is just these 2, 85% is these 2 dominant players in the government segment. Then you have this, these are the 3 or 4 major segments. Then you have this, say, loan against property, stroke SME, though I've given it in 2 different products. There is very slight, small line which distinguishes the SME finance and loan against property. I mean, just to help you understand, again, I'm not blaming or finding fault with someone, but just help all of us to understand what it is. Lab finance looks at the value of the property and relies more on the value of the property rather than on the cash flows of the borrower who will eventually repay the loan. It is designed to be in that manner, or people tend to take the value of the property into consideration for taking a lending decision. Whereas SME finance, though it can have a secured security as a property, SME finance is supposed to assess the cash flows of the borrower and rely on it more for the credit decision. That's why there is a very thin line of difference, and that's why we saw, because of this reliance on the property value of the property, we saw lap finance lap product growing very fast till about 2017 or 2018, since it started evolving in early 2010. I mean, early part of the last decade. So as the property prices were growing and there were huge balance transfers, borrower moving from one lender to the other just because my property price has increased. And of course, cheap money also enabled the lenders to price it very attractively. So thankfully, all of them stopped, or more or less stopped, in 2017-18. And therefore, we did not have any major issue in that. Yeah, Archana, you have a question?
Hi. Yeah, my question was with regard to the lab finance. Do we have ongoing monitoring mechanisms with respect to mark-to-mark monitoring, considering the fall in the property prices due to the COVID situation and other real estate meltdown?
Okay. So, see, the general approach of the NBFCs is not to do a mark-to-mark type of arrangement, because it actually pushes the borrower further into trouble. So what has happened is, Archana, that LTV values which were very low at the time of origination, or somewhere around 20. If you look at few years back, most of them said LTVs are around 30 or 40%. That has gone up now, either because of property prices. I wouldn't say going down, probably in some localities or some geographies or in some micro markets, property prices might have gone down. Both, I mean, this is a very concentrated market, right? You see most of this lap in a large 5-6 cities, probably Bombay, Delhi, say Bengaluru, Ahmedabad, Pune, not even Ahmedabad, Pune, Hyderabad. So the top markets of real estate, you see few of them operating. I mean, this product being in these cities only. So the LTV has gone up. What it used to be around 30s or 40s in few years back, I'm sure it would have gone up to 50, 60 or even more, or even 70 in some cases. So still, I think the lenders are not out of the money in most of the cases. But the question to answer here is what happens if a large number of lenders throw the property into the market for realizing the money? It can pull the values further down, and it can be a very vicious cycle. So if there is a fear of property prices coming down, more people will try to liquidate the property and take the money back, and then it can further pull the prices down. So that has never been tested, and hopefully it should never be tested. If that is going to be tested, I think this LAP, which is roughly about 2.5 trillion size, can have a very disastrous impact. So, I mean, to answer your question, I don't think there is really mark-to-market type of this thing they are looking at. It's more kind of even those who have relied on the property prices, I believe, have kind of changed it and trying to kind of engage with the borrower to ensure that defaults are minimal. Because there is no way he will bring in additional property. Yeah, in some cases, in odd cases, it can happen. You want to be sure that your LTV doesn't move up, say, beyond 50%. In that cases, it can happen, but hardly it happens. It doesn't work that way. At least I've not seen in NBFCs. So yes, LTVs are higher now. That is an issue.
Per bedroom.
And hopefully it doesn't kind of get out of hand. Yeah, if you look at the delinquencies, they've been steadily going up. They've been steadily going up. What used to be around 1.5% to 2% is well over now 4%. Gross NPA 90 DPD. So that has steadily gone up, and that's a very clear indication that there is stress building in the this thing in the segment.
In lab cases,
sorry,
this 4% in loan against property, right?
Yeah. Lab.
And what about SME finance? How much?
See, SME finance, it will be on the higher side. I don't have specific numbers because it's difficult to get for SME finance. But if you look at from as a bank as a kind of indicator, banks, it has well above. I mean, it was around 8-9%. Now I think it has gone beyond 10%. Similar borrowers or even NBFCs will have even one notch borrower with one notch lower credit profile. So if banks are around 10-12%, SMEs must be at least around that. Yeah, given that NBFCs have better collection mechanism, I would still believe that it will be 7-8% at least in this SME segment. Achana, does that answer your question?
Yes, it does.
Or any further thoughts you have?
Yeah, because the further thoughts which I had is with regard to the regulatory aspects regarding monitoring of the LTV, in which now in the situation they are also looking at ongoing monitoring of the LTV, given the fall in the prices. But as you said that it might lead to a further meltdown if there is a lot of supply, a lot of liquidation which is happening. So,
Right.
yeah. So
Right.
given this situation, yes. What is it that can be done by the NBFCs for realizing the delinquencies?
It's more. I mean, borrower engagement and follow-up is what most of them are doing as of now, rather than relying on the property as just a. Because it has never been tested. This product has never been tested in the past. Whether property prices you can rely. Banks at least are better off because Surface yes now is available for NBFCs as well. For at least banks, it has been a well-tested product, but not so for NBFCs.
Right. Yeah. Fine.
Yeah. So I have a few more slides. I think a couple of slides are more important in terms of asset quality. I'll go there. Yeah. So the earlier slide we saw the type of products. Here I've put the products in the increasing order of risk from left to right. Home loans being the least risky, and personal loans and credit cards being the most risky. Home loans, it's a very, very tested product. Yes, there is a huge property collateral, which is a big deterrent. And if the borrower is living in the property, it's the biggest deterrent against default. And also, as I said, it's a very well tested product. 40 years in existence, seen many cycles. So well tested product. Here, I'm not talking about the affordable housing segment. Affordable housing typically means a ticket size of about 10, 12, 15 lakhs or even under 10 lakhs. But affordable housing also means you're giving loan to a borrower with no credit record, or which banks will not give because they don't have a documented income proof. That segment I am not covering here in this home loans. That I think is probably somewhat towards the medium to high risk, because the type, it is not just the borrower who is much weaker, because the same, as I said, the chai wala or the small kirana shop owner, or the anybody in the SME segment who is getting the SME loan under the SME segment, he is getting a home loan. So that's the type of borrower you have. So it is nothing but an SME kind of lending when you give affordable housing loan to those borrowers. It's nothing but an SME loan, but used for housing, and you have a property. I mean, it's better than SME because you have a property. But I have an issue with the property also, because I've seen in many companies that liquidating a property is the biggest issue. I'll give you an example. The company which I was having relationship, this company, okay, there was a default, and then they repossessed the property, and they were trying to sell the property. And to their much dismay, they found that the value is much lower than what it otherwise fetched, because it did not have a proper approach for a four-wheeler. Okay, probably it must have been in some remote place. So the risks you don't know. I mean, they were trying to sell the property on. First thing is the difficult to get a buyer, but there they found that it was a very small road. There was no four-wheeler approach, and therefore the property price was much lower than the normal price which otherwise they thought the property would fetch in case they're going to auction. So such risks are very inherent. They are evolving. People are not fully aware of it. I mean, there are so many such examples which I could see. And after which the company changed their policy, saying that they will not fund any property where there is no four-wheeler, there is no wide road, say for whatever they decided, 15 feet or 20 feet road, they will not fund any such property. So people are understanding the risk. And again, it's growing very fast. So such issues are there. But as I said, this is the home loans which talking as safest is not that part of the segment. Gold loan, again, liquid gold, you can auction anytime. It is at the possession of the lender. So I would even say, I would even put gold loan and home loan at the same pedestal in terms of risk. But only thing is that gold loan has a shorter track record. Just about, say, I mean, gold loan has been there since centuries, in fact, at least in the southern part of this country. But just give me a second. I'm running out of power. I'll just connect the charger. Just give me a second. Sorry. Yeah, sorry. So gold loans have a shorter track record in terms of the size in which they are, that is that as a segment, which has been there for the past, say, 7-8 years. Otherwise, I think I would put it on the same pedestal as the home loan. New car loan, not very risky because of the type of the borrower. Typically, a well-heeled borrower gets this. Used car is, again, the value of the vehicle will be lower and therefore slightly lower than the new car. Loan against shares, very least risky product, but since it is dependent on the market also in terms of value, it is not as safe as, say, home loans. Otherwise, it's a if you get your model right, if you are having your risk management practices and it is strictly implemented, LAS is one of the safest products and also well-paying product. Commercial vehicles, again, very matured industry. New commercial vehicles, matured industry. It has been there since 30 years. Every risk is understood. Very well clear delineated segments of business. So that's why it comes in the higher takes in the risk spectrum. LAP, because of the property you have comfort, but as I said, the recoverability of the property or of the recoverability of the loan based on the property value is something yet to be tested. And till about 2017, the balance transfers have been very high, even up to 40%. So it has just been the last two years or so where I am seeing a track record of the borrower. Otherwise, I don't have a track record at all. This is a product which came in, which started growing fast in the early part of the last decade, and balance transfers happening. So I don't have a strong, longer track record of a borrower of this product, or this product as such. So, but the property price, the property value gives me some comfort that way. It is coming somewhere close to mid-size or a mid-range of risk. But as we gain more understanding about the risks involved in the product, as balance transfers have come down to a very large extent, we'll be able to either place it in the higher order of risk or in the lower order of risk. SMEs, again, the borrower profile is weaker and the business segments are quite vulnerable. You know, in this COVID, I think SMEs are the ones which have been more affected, and that's why it is in the mid order of risk. But the compliance culture with SMEs are pretty strong. They are, if you look at any lending segment, SME segments will have a better compliance culture. Their willingness to repay the loan definitely would rank in the highest order. Used CVs, again, the borrower profile is weaker, and the purpose for which the CVs are used are again vulnerable to income volatility and therefore mid-range of risk spectrum. Commercial equipment, bit of both, that the bit of the business as well as the borrower profile, because it tends to be SME type of borrowers. Of course, you have the large companies, construction companies having their own equipment, but a major portion of the or a large portion of the funding is to SME type of borrowers who buy this and lease it to the construction companies, and that's why it's on the slightly lower order of the risk spectrum. Tractors, it's entirely dependent on monsoons, or to a very large extent dependent on monsoons, which is again a big uncertainty. Three-wheelers, again, the purpose for which it is used for short-term, short distance transports. And of course, you have the ubiquitous auto, which is a major three-wheeler funding. And of course, the borrower, the type of the borrower who's, if I have to put it in very simple terms, a guy who is finding it difficult to meet his ends, make his ends meet every day, will have poor financial flexibility, right? If there is a problem in his family, if there is a problem, external issue, then he's going to default, and he cannot pay two EMIs together. It can never happen, because that's the level of tight funding, that a tight ship that he is running. So the very, very limited financial flexibility in three-wheelers, the borrowers of three-wheelers, for used CVs, that's the bigger issue. If a default happens for 1 month, most likely it will continue. I mean, I'm assuming that he's recovering from that issue, and he goes on with a normal life. That default, he'll not be able to pay 2 or 3 EMIs together, and therefore it will continue till the loan is fully repaid. And therefore we see higher gross NPAs here, but lower ultimate losses in these segments. Two-wheelers, quite risky because of, again, the borrower profile. Consumer durables, very risky, which is again, the consumer durables segment has been doing pretty well in the past few years. Probably the customers or the lenders are focusing on customers who have strong credit score of track record of repaying loans, and therefore the consumer durables seems to be a very safe segment, but the recovery is something which is uneconomical here. You can't, it's a very short, small ticket sized loan ranging from 10,000 to even say 1 lakh or so. So recovery is quite uneconomical. It's difficult to recover. You can't have armies of people doing recovery. So you have to rely on the borrower profile. So if there is any aggressive selling happens here, as it has been happening in some of the companies, smaller companies, probably the asset quality issue will kind of show up. Personal loans, credit cards, as you know, no security available. Again, these two segments have been showing very good asset quality numbers for the past few years. Probably again here, the focus of these lenders, both banks and NBFCs, have been the top-notch borrowers in the top credit score, with top credit score, and therefore it has been having a smooth sailing so far. Again, the test of COVID will be a bigger test for credit cards and personal loans. Let us see. And if this business is to be scaled up, again, we will have to see whether the asset quality can hold up. So I will take questions after completing my slides. I have a couple of more slides. I will take questions after that. So again, I'm going segment wise, how the growth is going to be. Most of the segments will have very poor growth this in 21. I have not put 22 because it's difficult to kind of get a better picture in 22, but expectation that the economy will pick up in 22 and therefore the performance of all these companies will be better than 21. That's a larger idea we have today, because economy is going to grow next year by whatever number, 8%, 5, 10% or whatever number, because this contracting this year, likely to have it contracted by end of this year. So economy will pick up steam next year, or pick up growth, or return to growth path next year, and therefore most of these segments should be what they are doing this year. Couple of segments which will do better this year. One is gold finance. It has been doing pretty well because there is demand for cash, and this is easiest to get. You have gold in your hand, you can borrow within a couple of hours maximum. So that is doing pretty well. SME segment is expected to do a little better because of government's push to banks, mostly banks and to some extent NBFCs, to lend to these SMEs under the emergency credit line scheme. And again, infrastructure is going to do little better, maybe equal to last year, because again, government is pushing REZ and PFC to lend to the discoms for meeting the working capital expenditure. So other than that, I don't see any commercial push to any of these segments. If you look at housing finance, it's going to be lower than last year because the housing, the demand for housing is going to be 50-60% lower than last year. We are seeing some great numbers in October, but I think the 50-60% downside or the decline that I'm talking about is for the whole year. Auto finance, again, the industry might have done little better, either the passenger vehicles or the two-wheelers in the past month or two, but it's going to be much weaker than last year. Last year itself was a very weak performance for auto, and this year it's going to be weaker. And therefore, auto finance companies are not going to do great in terms of growth. Microfinance might just come back a little bit. Of course, they grew 30% in 20, which is a decent number. But this time, disbursements are yet to start, or probably they started in the last few weeks. So therefore, we don't expect much growth in microfinance. MSME, as I said, demand is there, but lenders are very wary of lending to MSME. other than under the ECL scheme of the government. Consumer durables expected to fall drastically, again because of the underlying poor demand for the underlying products. So not much this year. I mean, it's not something which unexpected, we all know, but just gives you a perspective of how the picture was in 19 and 20 and how it's going to kind of pan out this year. Again, segment-wise asset quality, because it doesn't make a sense to look at asset quality together. Like for bank, you can say asset quality gross NPA is 8.5% or 9%, but here it doesn't make sense that way because different segments give completely different set of numbers. We are not going to see any major deterioration in any of the segments, except of course the wholesale finance, which I spoke about. Mainly because of restructuring. There was moratorium till August 31st, and beyond that, by December 31st of this year, whatever is the stress that will get restructured, and we will hardly see any major uptick in gross NPAs by March 31, 2021. So the estimate of restructuring is somewhere around 10%, 8 to 10%, maybe slightly on the higher side. Because moratorium was roughly, again, we don't have very clear numbers because definition of moratorium was different for different people. They have adopted different definitions. Like someone said, if someone is paying for 2 months out of 5, I will not put it under moratorium. If someone has paid for 3 months, I will not put that loan under moratorium. So people had different definitions. But broadly, for NBFCs, somewhere around 30% is the moratorium for all of them on an average. And a part of it, at least 1/3 of it, is likely to get restructured. So my number would somewhere be around 8 to 10%. Probably it may be slightly higher, but there are some very stressed segments, and therefore. But if you look at the collection efficiencies, which people are reporting, it's pretty high. But that's about the collection efficiency for the current period. As I said, the stress which the earlier periods stress that moratorium would not show us, that is to be seen, and therefore I still believe that the restructuring is likely to be around 8 to 10% for NBFCs overall. Without going into the specifics of the segment, as I said, it's difficult to get that data in terms of specific. Yes, not all of them will be 10%. Some of them may be lower, and some of them may be even higher than 10%. But one segment here, microfinance, I don't think there'll be any restructuring because it doesn't work with that kind of people. So probably whatever is the stress that is there, that can come out in the microfinance segment. And wholesale finance segment, the incipient stress which we were talking about, what will come out is, of course, is this 12 to 15%. I put it again slightly on the higher side. Probably somewhere it will be around 12-13%. So just as a refresher for all of us, the liquidity position of NBFCs actually were quite weak for most of the NBFCs, particularly the mid-sized and small-sized ones at the beginning of this COVID. And during the moratorium was supposed to be given, and had and anyway they were under some sort of liquidity stress. And if collections are not going to happen, probably it would have resulted in many more defaults. But for this support from government and RBI, or government through RBI, I should say. So these are some measures: long-term repo operations, and then special liquidity scheme for NBFCs, HFCs, partial credit guarantee scheme. These schemes actually restored the confidence of the market. Yes, NBFCs got funds, particularly the mid-sized and small-sized ones, which did not have a strong parentage, and there were no many lenders to these NBFCs because mutual funds were quite wary of these NBFCs, and therefore funding was a big problem. There was no collections that were happening because of moratorium, and they did not have, many of those NBFCs did not have a moratorium on their loans, and particularly the capital market borrowings in terms of CPs and NCDs. There were no moratorium at all. At least banks, some of them were giving moratorium. So for capital market instruments, the mid and particularly the mid-sized NBFCs would have been deep trouble, but for this liquidity schemes announced by the government. So it actually has helped some of them, and actually the number may not be high. Few NBFCs or few of them would have benefited, but had there been a default, it would have been a tremendous stress on the entire system. That was saved because of the government's efforts. So that's my presentation. I now can take about questions. I think we are at 12:20. I've already exceeded my time by 5 minutes, but I will still take some questions if there are any, or any comments, maybe in another about 5 minutes.
So Ramesh, Aditya, like how do you think RBI will get into action now? Like, will they make a few NBFCs moving to banking segment, like giving banking license, or what kind of other controls they will bring in to control these big NBFCs?
Yeah, I think that's a very pertinent question as far as large NBFCs are concerned. When I say large, what I have in mind is the asset size in excess of 1 lakh crore. Or maybe even 75,000 crore. But see, the problem here is the NBFC model offers some benefits which the banking model doesn't offer. Okay, first one, the biggest one I think is the requirement to maintain the SLR, right, and CRR, and the other compliances that you have to follow. And you have a very clear guidelines on promoter holdings, which we have seen playing out in many banks as well. So because of this regulatory arbitrage, many NBFCs do not want to shift. They want to continue with the model, but beyond 1 lakh crore or beyond 70,000 crore, Bajaj Finance is about almost 1.5 lakh crore. If they're able to manage, they are pretty comfortable managing or going that way. So while RBI may kind of do a push, it has to come from the NBFCs themselves. So once they find this model bursting at the seams, then they will think of switching to a better model, probably the bank model. If you look at Bajaj is able to raise funds, both debt and equity, very comfortably, right, at its will. To some extent, Shriram, the other big NBFC, with above 1 lakh crore, is not that comfortable in raising funds. At least if you see the last 1-2 years track record, Shriram has not been able to. It was the first company to go overseas also to borrow at the time of liquidity crisis. Probably they were trying to say merge with IDFC, sorry, not Capital First, sorry, IDFC Bank, right? So, and they were also trying to do some other thing. So it has to come from the NBFCs, because these NBFCs are hugely valued. Look at the market cap, and it's a big stake for the promoters, including the PE investors. So it's more the market dynamics, the evolution will drive here, and regulator of course will give a push. But my sense is that if the NBFCs find their model difficult to sustain beyond a point, only then they will move to a better model, probably a bank. Yes, of course they will have issues there in terms of their profitability, in terms of the very stricter regulatory compliance, in terms of promoter holding. We had promoter holdings with Kotak, Bandhan Bank. RBI forced SFBs like Equitas and others to kind of make it they made the banks go public. So a lot of promoter holding issues, very stringent guidelines. Many of the investors may not want to comply with those guidelines soon. 3 years, 5 years, 10 years may not be a longer period for the promoters. So those issues are there, but only the business dynamics can make them convert to a bank.
Thank you.
Yeah. So are there any more questions, or we can move to the yeah. So Dhananjay, you can unmute and you can ask. No problem about it. Okay, so there is this question from Mr. Dhananjay Bagrodia. He wants to know how does liquidity and funding work, and why can't RBI give unlimited liquidity?
And I want to add one more question into it, if
Yeah.
possible. So RBI has given the window, liquidity window, but the small NBFCs are not still getting the funds because the due to issues of the you can say the credit rating and other stuff. Okay, so like all the small NBFCs are really not getting the funds. They have all the same issues. So this is a very big thing. Like if you are giving the liquidity window, then they are not getting, then how they will fund to consumers or maybe SMEs or the underserved person, right? So kindly give answer for that, right?
Sure, sure. The first question is on how RBI could increase the liquidity. Um, See, I think as Vikas said, the liquidity for the is a bigger problem for the mid-sized and small-sized, and mostly the small-sized NBFCs. The larger ones, which had either the strong parentage or which were doing prudent business. As I said, there is no major ALM issues. Those NBFCs were able to kind of, or even now they're able to raise funds. If you look at the NCD issuances, it is mostly by these large ones, either the government ones like PFC, REC, or the large ones which are AAA or AA plus. So those don't have an issue. The problem is with more mid-sized and small-sized NBFCs where market is very wary of lending to them. Now the question is, RBI has taken a stand or government has taken a stand, and in my view it is also right, that I will support those NBFCs for a limited period to tide over the liquidity crisis, not for your say regular business lending. That's why they came out with this special liquidity scheme for 3 months, which has to be repaid in 3 months. Whereas I think the market was expecting that it will be for a longer period where they can kind of continue with the business. I think the way forward for them, for the mid and small sized ones, is to kind of use the schemes given by the government for the shorter period so that there are no, say, disruptions in the market. Even one NBFC defaulting is going to be a big news and is going to shake the confidence of the entire system. So once actually before this COVID, if you look at least since say June or September of last year, the market was kind of warming up well towards NBFCs. They clearly distinguished who are the players who are in trouble, who are the players who are doing better, and liquidity was slowly coming back to market. But actually, COVID put that back to 2018 level. So my sense is that once you get a clearer picture of how the pandemic is going to get controlled, I'm sure the well-performing ones in the mid and small-sized ones will get funds for business, for growing the business. Maybe it will take another quarter or two. It depends upon our view of or how the second wave, the supposed second wave of pandemic, whether it comes or not, or how long it takes for us to come back to the new normal or near normal, whatever. So once that happens, I think lenders will definitely be looking at lending to NBFCs with a good track record, be it small or be it medium. It's more because of the COVID-related situation. That's largely my take on this. Yes, it's going to be tough for the next few months till this pandemic is out of the way.
Yeah. Thank you very much, Rameshji, for the enriching session.